We are, as you know, green across the board. WTI, there it is. It's back, though, at 90. So keep your eye on that, and thus keep your eye on the stock market. But that's the relationship that matters most of all. As everybody seems to know, oil down, stocks up. Pretty simple. How about another one? Stocks down, Trump put.
Yes.
Pretty simple, because Citi today says the so-called Trump put still prevails.
Yeah, I would agree with that. And I think that where we found that Trump put was specifically in the oil market itself. There's optimism certainly built into the tape over the last 48 hours.
Cautious
for sure.
Optimism, maybe,
well,
right?
I think what you're looking for is the confidence that you can find the evidence that you're validating that optimism with obviously some form of a resolution. So in the interim, I think you're going to see volumes begin to thin out. We saw that yesterday. We are also approaching the end of the quarter. Again, that might lead to a little bit of volumes thinning out. So I think you're looking for some tactical setups. I think I found one yesterday in gold. I really think right now, while you're sitting in this waiting period to confirm the optimism, that's really your best weapon.
Jenny, you can get an idea that firms are trying to game this out a little bit, think they can start to maybe look beyond it. JP Morgan's trading desk says they're closing their tactically bearish call and they're moving to neutral. Now, it's just a move to neutral. However, it does signify what I think is fair to say, this cautious optimism that there's going to be some level of resolution in the nearer term, rather than having this drag out and potentially get worse and have oil spike way up yet again, and you know exactly what that would do to stocks.
Right, and I think when we're thinking about kind of gamifying it and playing it out, the way I've approached the last several weeks is to really, to the best of my ability, ignore the politics and follow the economics. And if you follow the economics, that's where you get, because the economic pain right now, or the potential economic pain right now.
I'm glad you used the word potential, because it's too soon to have seen significant economic pain. Obviously, going to the pump and paying $4, which is where gasoline is now, and if you're diesel, it's a lot more than that.
Right,
and certainly in some states.
Right, and if oil really does go sustain at 115 or 180, the potential economic pain is devastating, and it's devastating to everyone. It's devastating to everyone in the Middle East. It's devastating to everyone in Asia. It's devastating to us in the U.S. And so when I think about the taco or the Trump pivoting or whatever it is, I'm really thinking of that more as follow the economics, because that's ultimately where he goes. He goes, in the end, I think, towards what's the best economics for the United States.
Oh, I don't know. I think you follow the stock and bond markets. I mean, I think those have proven to be the triggers, if you will, that matter.
It's one and the same.
No, it's not. No, they're not the same, because, as I said, you can't make a call on the economy based on this yet. But you can make a call based on the stock market unraveling and bond yields getting a little bit away from us.
But I said the economics, not the economy. Right, and the economics of what's going on is devastating for stocks, right? If oil prices are suddenly at 180 in a sustained way, the economics for the company.
180.
I mean,
okay, but you know what? That was thrown out there. Say 115. All I'm saying is you follow the economics and say, okay, does this make sense? Like, how does this company work? How does that company work? And then it hits the bond markets. How do the economics work here? Well, it creates huge inflation. That's bad. So you could say it that way. I'm really not talking about the economy. I'm talking about the economics on a stock by stock basis, on a company by company. And that's what you see reflected in the stock market.
No, but my point is that you've already had a backup in yields that was getting a little uncomfortable.
Yep. And
you obviously had a come down in the stock market that was getting very uncomfortable. Some would say, well, we didn't get truly and technically and historically oversold like you should. And I said, well, the only barometer that really matters is the one that lives at 1600 Pennsylvania Avenue. And to that market watcher and technician, we were oversold enough. And that's where the Trump put, as you know, as it was called again today by Citi, prevailed.
Yeah.
Here's a little interesting factoid. When we're talking about economic impact, I, of course, go to what's the earnings impact. Earnings in aggregate for the S&P 500 have been revised higher over the last month. That's a little bit of a head scratcher. That's a little bit of, wait a second, they've been revised higher for this year by 2% since the beginning of the month. And by the way, that has helped the markets, definitely. That's a reason we're not down more with oil where it is now. The forward multiple on the S&P 500 is now 20. We were doing a lot of reasonable hand-wringing at the beginning of this year with that multiple approaching 23. Now you're at 20 with good growth projected. But ultimately, that growth could come down if we do, in fact, see this continuing hostility, which we can't rule out. Scott, you twice said cautious optimism. I am optimistic. I added to equities on Monday. I bought eBay. But that caution is there. We've got 4,500 Marines inbound into the theater. We've got the 82nd Airborne coming in. This is a president who does not like to bluff, and he's going up against a country that doesn't really back down from any saber rattling. So we're not through this yet.
Yeah, no, that's clear. Josh, and I'm wondering, how you see things. It seems pretty simple in terms of what to watch, not to make light of or oversimplify the conflict in any way, but from a investing or trading perspective, we do what we do and we look at things the way we do. And looking at that move in oil seems to be the most significant, if not the only thing that matters most of all to this stock market right now.
I agree with everything that you've said. The program is 6 minutes old. And so far, Scott, you've done nothing but drop truth bombs. And I'm not here to kiss up to the teacher, but that's the number one thing on a day-to-day basis. And if you're a long-term investor, it shouldn't matter that much. But if you're trading this market, oil red, stocks green, period. There's no nuance. That's what's going on. That's number one. Number two, the other thing you said, Scott, which Jenny is wrong and you are right, we don't know the impact. We know it's a negative impact, but we don't know the extent of the impact of the price of oil on the economy. I'll tell you in 6 months when we have the third revision to GDP. Scott is correct. It's the stock market. And if you think Scott Bessent doesn't call the Oval and say, Mr. President, this is Friday, the S&P 500 is just broken below its 200-day moving average for the first time since May 2025, I'm not even saying Trump would ask, well, do I care or not? I think it's instinctive. And to me, it's not totally shocking. The president has to deal with real-time news and information, not just geopolitics, but economics. And he doesn't have the economics at his fingertips. He's got opinions, but he has the stock market right in front of him. We know this administration cares what happens with the stock market. We know when it's going up, they view it as a report card of sorts. So I'm not totally shocked that there was like a tweet after the close on the day that we finally broke below the 200-day. I don't think it's an accident. And I do think the ongoing talk of maybe a truce, here's a 15-point plan, I think so long as the market stays green as that news flows in that direction, you could continue to see that. Here's the problem. Look at the tone of the bounce. You know what's the leading sector in the market today? The only sector up 1% or more? Utilities. You know what's number two?
Materials.
Yes. You know what's number two? Healthcare. Materials. This is not the environment of 2025. The problem is people don't know what time it is. They want it to be 24, 25. They want it to be led by cyclicals. They want it to be led by tech, and it just isn't. Financial is the worst sector today. They're actually the only sector red as I'm talking. So you need to know what time it is. And the time that it is right now, we do not have convicted bulls in this tape. They're not here.
Yeah. Well, it's a good point, too, because the convicted bulls, if you want to refer to them in that manner, retail has been bullish and has had a consistent level of conviction about this market, enough so that at every moment of upset, they have been buyers. You have to wonder whether that is changing now, based on some information from Vanda Research, which says mom and pop traders on Monday notched their first day of net selling of single stocks since 2023. Okay? That came as the market rallied. Retail was selling into it. The first day of net selling of single names since 23. So, Joe, what do we make of that? What's the significance of it if it continues?
Let's see if a trend develops in that direction, because that is counter to what the behavior has been over the last several years where retail is buying. So let's get further information over several days, several weeks to confirm that. Josh mentions the tone of the market, and I think he infers there's a little bit of a weakness in that regard to this bounce. I agree with that. Let me explain that a little bit further. I had conversations in the last 24 hours with two systematic trend-following funds. They both said the same thing to me. We're neutral. in terms of our bias. We've been carrying equity exposure to various indexes throughout the world as being long for the last several years. We are now neutral. We flattened it out. Why? Today would be the 5th consecutive day that you close below the 200-day moving average. Now, look, the 200-day moving average might mean nothing to you, but if enough people are using it, it's a variable in the market. And for those funds right now that are following that, and they are a force, they now have a bias of being neutral for the very first time in many, many months.